My name is Tim Craighead. I'm one of the research directors and the chief content officer at Bloomberg Intelligence. And this is the 23rd Trend Watch webinar, actually, that Evenco and Bloomberg Intelligence have partnered to come together with. We're looking forward to what I think is a particularly timely topic and arguably the most important thing we're all considering as investors right now, right here, investing in a Trump 2.0 world. Before we start, I'd like to take care of a couple of things, housekeeping and otherwise. One is, thank you most notably to Evenco International for being behind this to organize. I think many of you listening are probably aware that Evenco's core business is hosting in-person fund forum events across Europe. It brings together investors and asset allocators for listening to a compelling set of funds. There's actually one tomorrow here in London if you happen to be in the UK. 8 funds across equities, fixed income, and beyond are going to be making a good pitch. There's several more coming up over the course of the next few months: Scandinavia, Frankfurt, Spain, and then across Europe through the rest of the year. And we do a Trend Watch webinar roughly every 2 months. So there's a lot of content, a lot of insight to be offered in a pretty unique venue, or a couple of venues. And just to mention as well, from a Bloomberg Intelligence perspective, in case you weren't aware, we are the investment research arm within Bloomberg. We've got almost 500 professionals covering all major markets, sectors, industries, across asset classes, 2,000 companies across equity and credit, and all the data and research we have is available on the Bloomberg simply as part of the terminal subscription. So, you know, that's the little upfront unabashed ad for Evenco and for BI. Let's get on with the agenda at hand. We are here for a panel discussion, call it 40-ish minutes or so, plus Q&A. If any of you have a question, please feel free to pop it in the chat, and we'll try our best to get to the questions. Most importantly, as part of this discussion, we've got 3 fantastically experienced chief investment officers with us. Edward Smith from Rathbones, Johan Thordenberg from Swedbank, and Thomas Will from Copernicus. I'd like each of you just to give a little bit of background. You know, I'm an old equity hand with 30-odd years of experience, but you know, I'm in the world of equities. You all have cross-asset experience that I think is quite interesting as we consider how to think about what Trump means for markets. Edward, do you want to kick off with just a smidge on where you're coming from?
Yeah, sure. My background is as an economist, undergraduate and postgraduate degrees in economics and history and economic history. But I've spent most of my career as a cross-asset strategist before becoming CIO of Rathbones, which is a long-only multi-asset wealth manager.
Very good. Johan?
Yes, my name is Johan Thordenberg. I'm representing Swedbank here. I have a background actually as a management consultant from the beginning, working a lot within the financial industry, but with a core interest for asset management, and converted later in life to the CIO part of the business, and have been doing so and working directly in markets for the past 3 years.
So I guess it's turning on me. Well, 30 years in the business representing Copernicus here. Tim, you might be surprised, the first 10 years I was also on the equity side. I was one of the guys who was fully part of the .com bubble, even had my own technology fund there. But I would say like the last 15 years, I was also more on the cross-asset side and really, try to enjoy, the bull market of the last couple of years.
Yeah, indeed. That was laughing with somebody earlier late last week about I I got into the equity business in August of '87, just in time to be sitting on an OTC trading desk at an investment bank in October. That was a good, fun experience. Anyway, let's get on with the topic at hand. I'm going to occasionally share a slide just to set a stage. But the first topic that I want to address is, there's a battle that we think is getting ready to start. There are many expected policies. Some are tax cuts and deregulation that should push growth. Others are tariffs and immigration and other elements that might be inflationary. There's a battle between the impacts of these policies, the timing of implementation of these policies, and certainly I think there's a reasonable discussion about how it can create volatility. We've had day one. We're in the midst of now waiting for the rest of the 98 days and the 100 days, but we don't think the battle stops at that point. I'd like to jump in with you all as investors. What are one or two of the most anticipated policies or initiatives that you think are going to be most impactful to the market? I'm curious just to get a sort of sense check, and then we can dive into some of these things as well. Who wants to go first?
Yeah, maybe I can go first. Just to get started with, President Trump's first day in office was consistent with his campaign promises and appeal, of course, to several of the highest priorities of his fund base. Control immigration, reduction of inflation, by unleashing U.S. energy, and cutting governmental regulation. I would say that the most surprise of this was, of course, the mass deportation bit. And of course, that will be extremely important to monitor going forward. The outcome of this topic, because it will absolutely certainly drive inflation. On the other hand, just as a comparison, last time Trump was in office, he actually deported less people than Obama did during his time in office. So we should all watch this and see the outcome of it before we jump to conclusions, so to say. But of course,
fair enough. Yeah, Edward or Thomas?
Sure. Maybe just at the top of today's event, I should say that we're pretty skeptical about any investor's ability to really accurately predict politics, and particularly President Trump. We prepare, we don't predict, we closely analyze for potential policy changes, stress, try and increase resilience, but there's a lot that's unknown. We don't try and predicate trades off the back of them. And I think actually the president's own words throughout Inauguration Day have just served to remind people of really the inscrutability of what he's going to do and when, and that and when is quite important. Because at first we heard quite a slow and measured approach to the introduction of tariffs, which is probably one of the biggest downside risks from Trump. And that fueled the bark worse than bite school of optimism that pervades many equity investors, I think, at the moment. But by the evening, the rhetoric had been replaced by musings about applying 25% tariffs on Mexico and Canada within the fortnight. And tariffs are the Swiss Army knife for policymaking for Trump, right? He says, and this is in his own words at various points on the campaign trail, they can be used to shrink the deficit, devalue the currency, reindustrialize the heartland, raise revenues, stem migration, stop illegal immigrants crossing the Mexican border, and stop the trafficking of Chinese fentanyl. Now, the logic of how tariffs can do all of those things all at once is pretty hard to follow. And that's kind of my point, right? Is trade protection the end goal, or are tariffs just a bargaining chip? Because if they are a bargain chip, then maybe they'll be dangled or even implemented for a few months and then lifted, and that actually could lead to a big relief rally. The order with which he does these things really matters, and that's what we're going to be really scrutinizing. Do the inflationary risks from tariffs or mass deportations, as Johan highlighted, come through before any positive effects from any tax cuts or deregulation, if he manages to get them through.
I think that's quite sensible. Thomas, how about you?
Actually, I'm quite happy that Edward said that it's really hard to predict what the president is doing, and quite frankly, sometimes I have the feeling that even he doesn't know what he might do tomorrow or how he changes it, and we don't have to go down the rabbit hole and say, okay, what is already priced into the market. I mean, he has a lot of initiatives, and he has to, he has to more or less make his fan base happy. But you can't, you can't have everything. And from my point of view is that one of the major reasons why he really got elected was the inflation topic. And that actually goes hand in hand. Some of his initiatives are clearly inflationary. We don't have to be a senior or chief economist to know that. So it will be kind of interesting to see also how he deals then probably with the Fed if inflation remains as sticky as we have seen in the last couple of weeks and months. And as I said, is that you can't have the cake and eat it. So he will come maybe earlier than even he is imagining to a crossroads where he has to say, okay, can I go to the left or can I go to the right side? And I think he will watch the S&P 500 very closely, because in his first term, you probably remember that in Q4 2018, it was a very difficult quarter for markets. It was also one of those debt ceiling events we had in Washington. And I remember it was Christmas time when Trump was tweeting out of the White Office, "Poor me, I'm alone," and actually nobody helps me. So net bottom line, I think he talks a lot. He likes to talk a lot, but let's look what actually will happen at the end, because also Johan said at the beginning correctly is that in his first term, he sent much less immigrants back than Obama did in his second term.
Yeah, I guess a couple of other. Yeah, go ahead. Yeah, Johan,
yeah,
go ahead.
I can just further on the discussion there with the S&P 500 being the benchmark for Trump's second term in office. I think that goes for the 10-year American government bond as well, interest rate as well. And obviously, I mean, the market has predicted that he will impose massive tariffs. On the other hand, in his opening speech, he didn't talk about tariffs in that extent and as provocative as he have done before. And he's more focusing on unfair trade deals. And of course, there's a big argument and negotiations to be done there, especially with China when it comes to the automobile industry, etc. So it's all up for negotiations, I would say.
A couple of things I would throw in, echoing comments that you all made. One, I'm going to share one more picture because I think it was an instructive one that our economists here had put out that just gives a little bit of historical sort of view of tariffs. This is from a US vantage point, but you can see where the line has gone since the 1930s, 40s, down to basically nothing. And on the right-hand side, you can see what various proposed tariffs would look like. It is pretty eye-opening when you start to look at some of the bigger numbers, relative to where we've been. That was point one. Point two, again, leaning on our economists here at Bloomberg, on the immigration front or deportation front in particular, it's interesting because our analysis is much more oriented to the demand risk as opposed to the supply risk, i.e. you take away 5 or 8 or 10 million people, that's a chunk of demand, and they're actually looking more at the GDP risk than they are necessarily the inflation risk from that vantage point, but just another consideration. Both of those are clearly negative elements from an economic perspective, notwithstanding, whatever you might think about, the policy itself. And the last thing that I'd throw out is that as I have conversations with investors, one of the possible policy sort of second derivative implications or impacts actually is about the courts. One of the things that happened in his first term was a seriously big shift to more conservative justices within the US legal system. And not a lot has changed over the course of the last 4 years. If you look at retirements in the US justices, there's another big wave that comes through. And bottom line, there was a big Supreme Court decision that came across earlier last year because of the more conservative Supreme Court that threw out a thing called the Chevron doctrine. I won't go through detail. We have a significant report written on this I'd be happy to share. But essentially, what it does is start to put limits around regulatory oversight. The bottom line is, whether you like it or you don't, you've got less regulatory reach potentially on top of whatever policy that Trump might want to be putting forward. You could argue that makes the US that much more of a business-friendly place to go and do whatever you're going to do. We'll see, but chances are it gets a further extension over the course of the next 4 years, and it's another one of those economic impact things to think about that could be pro-US relative to everywhere else, all else being equal. I'll bring that to a close. One other thing that we had chatted about when we were first contemplating this call, I'm curious to go back and quiz you all on, is within the US specifically, there's an argument for old America versus new America, and the impact from a policy perspective. How does anybody want to jump in on that?
Yeah, I
think just to start. Yeah.
Go on, yeah.
I can start off just by reviewing the people actually attended the installation of Donald Trump. There were a lot of tech guys there, and I think that is also the message that he wants to send. I mean, there will be less regulation that currently has held back innovation. I think they will put on a much more pressure on the European Union when it comes to the big tech companies and their holding backs of certain initiatives for them in our region. Then, of course, increased tax cuts will benefit from them, and then they will, of course, keep on with the capex momentum that they have right now.
I mean, I think it's really a sort of game of snakes and ladders, and whether Trump is better for old or new economies. So if you think about tax cuts, I mean, we don't know if corporate tax cut is going to be a blanket cut or if it's going to be targeted. If it's going to be targeted, it's going to be manufacturers. That tends to be a bit more old economy. Even if it's blanket, right? Well, the sort of technology, healthcare, or the more tech end of healthcare, they're already paying much lower rates of tax than the 21% tax rate. The average technology stock in the S&P 500 has an effective tax rate of about 13.5%. So actually, our tax cuts to headline US corporation tax going to make as big a difference to them as to retail, consumer products and services, construction, who are more like 24% effective tax rates? Probably not. Tariffs, again, like the problem with tariffs is you don't know what's going to happen to the currency, because that obviously sort of could attenuate or amplify the effects. You don't know what's going to happen to do with import substitution, and you don't have a clear handle on retaliation. But if there is but just sort of the tariffs making overseas goods more expensive, if the dollar doesn't completely offset it, that would obviously hurt automobiles and parts, construction and materials, chemicals, industrial goods and services more than it does some of the newer economy models. And retaliation is a really interesting point, right? Because if you look at the retaliations that happened in Trump's first term, they were very targeted at areas where there was a real Republican base. So either in areas of the country which were very red, or in industries that donated more to Trump than they did to well, as Johan said, like the inauguration front bench was full of tech, right? Would some of the retaliation now come in an area that was ignored before? Obviously not in tariffs. Tariffs don't really apply to these sorts of services, but would you get some other kind of retaliation on tech? So I think that, again, it's just, there are so many moving parts, there are so many what ifs, that it's hard to say at this juncture whether this is going to be better for old America or new America, I think.
No,
But
fair enough.
maybe
Yeah, go ahead, Thomas.
Maybe if I can add here something, is that I agree there are so many moving parts, and it's really hard to also access how are the correlations between those moving parts. But what is actually clear for me, and I'm following Donald Trump since the late 80s, beginning of the 90s, is that he is primarily interested in his legacy. And he also knows this is his last term. And he has, I would say, la carte blanche for the next 2 years, because then we already have in 2 years are the midterms. So he must do a lot of, if he really want to change stuff, he must do it now. And even I was a little bit surprised how many tech, let's call it tech people, were on in the inauguration. And for me, this is a clear sign that they want to line behind Donald Trump. So whenever they have to fear something coming out of the EU, that he is like a kind of a shield for them.
But I think when it comes to old America, I mean, they really need to rely upon continued strong economic momentum. That is very obvious. Another part that is very obvious is that in order to stay competitive, the level of automation in traditional American industry needs to be improved. And of course, supported by the tech sector and further investments, and that those sort of investments are now broadening, that could of course be beneficial. Last time in office was a good time for US small cap. We continue to be very positive on US small cap, especially US small cap that have a large focus on the domestic market. But of course, it will be a big challenge for the old America to adopt to the new world, because I mean, apparently, I mean, with mass deportations and wages most likely going up, triggering inflation, you need to do something in your fabric to make it work a lot smoother coming for the coming 4 years.
Well, look, I think that's a good segue to actually get into more of investing as opposed to discussion around policy and certainly the what ifs that are out there. It'll be a fascinating ongoing journey from that perspective. First thing I wanted to touch on at least a little bit, and I'll share one more screen, is what are the implications for central bank policy? Because, you know, this sets at least part of the foundation of what's going to happen within the broader bond market, and it also sets a tone for, you know, valuation from an equity perspective. This is a screenshot on one of the functions, you know, many of you all might be familiar with, MIPR on the terminal. The green line right here is showing current expectations of the market for Fed funds rates. The yellow is where it was back in September, and clearly you can see that it's a very different sort of curve, a very different expectation on policy cuts, and part of that is sort of the digestion of what's going on from the standpoint of growth, inflation, etc. We could draw a similar line for Europe and the UK, and it's not nearly as extreme, but it's also similar. There's fewer cuts that are being now anticipated. How do you all think about what's going on from a central bank perspective, at least Western central bank perspective? Who wants to jump in?
It was
Edward.
interesting that Powell made a few comments about how the Fed was thinking about what's coming up at the last presser. I was surprised he mentioned it at all, actually, because they usually like to keep these things under their hat. But he seemed to suggest that when it came to updating the economic projections and the dot plots and the like, some committee participants were factoring in potential Trump policies, and some weren't. Some were taking a purist approach, saying, "Well, I'm only going to base my projections on what I know." So the fact that even then, before Trump had even hit day one, some members of the Fed were starting to think, perhaps even second guess, dare I say, what was going to come down the pipe from Washington, suggests that this, could be quite meaningful. And a lot of the impact of some of the more risky, some of the more negative parts of Trump policy really do all come back to inflation at a point when inflation is still not quite back to where we want it to be. Some of the underlying trends, like we've been optimistic on inflation for a long time. We still think there is more disinflationary pressure in the pipe, but we're not quite there yet. And that's very different to Trump 1, right? Trump 1, like we had a backdrop where inflation had been worryingly subdued. Central banks were convening conferences about where is the missing inflation, right? And the economy was operating below potential. Very, very different to where we are now. So I think there are a lot of policies that all point back to inflation at a time when inflationary pressures could be felt very acutely, very responsibly, and the Fed will take those into account. They won't look through the politics.
Oh, very good. Other thoughts?
I mean, if I can add here 1 or 2 points. I mean, already in 2024, but also for this year, we were expecting far less cuts than sell side Wall Street strategists have actually predicted. Simply because as long as the US is growing above potential, it's really not necessary that we see major cuts on the short term. The thing that surprised me a little bit how fast then actually the long end moved to the upside, because normally when the Fed starts cutting rates, then the long end stays at the level or goes also a little bit slower. But the elephant in the room is maybe also that investors want to have more yield when they are looking at the $36 trillion of debt that the US has, and they are, from my point of view, they're not seeing any fiscal discipline yet in Washington. And as I think somebody mentioned before, also about potential tax cuts. So I mean, which means is that the situation from Washington is actually not really improving. So I think the Fed. Edward mentioned it before in the last conference. For me, also talked far too much about Washington, about Trump, about potential impacts, because normally they don't do it. Maybe it was also something to show Washington, hey, we think about that. We will have a change in the White House. Nevertheless, is that inflation is not at 2% yet.
Oh, very good. Let's take it one more step. Talked a little bit about central bank policy. We've been hinting around equities, implications for fixed income. I'll show one more slide. Good old-fashioned equity risk premium in the US and in Europe. And all I've done here is take the simplistic earnings yield less 10-year treasuries. From a U.S. perspective, or a generic 10-year European rate. The U.S. equity risk premium has plunged, to say the least. Europe is still at a relatively decent rate, although certainly less than it's been. How are you thinking about equity versus fixed income allocation at this point, I realize Trump is only one part of a decision process. There's a lot of other components, but where do you think about this from a 2025 perspective, given where we currently now sit?
Well, I can go ahead. I mean, we're still overweighted in equity with the belief of a economic recovery spreading both outside the US, but also outside, particularly the tech sector. That we will see a second wave of tech and AI will need massive investments in infrastructure and energy supply that will broaden the momentum. And in my particular region, in the Nordics, we actually see rate cuts and continuous rate cuts. So for that perspective, on our local market, we are positive on equity. But of course, as you explained there, and the previous chart that you showed with the momentum when it comes to rate cuts, it's almost nothing going from here. So of course, we're moving into more thin air, I would say. But as long as the revenue momentum keeps up, there's no reason to back off the equity market, I would say.
Yeah,
maybe.
Go ahead.
If I can come back to the equity risk premium. I mean, the equity risk premium at zero just tell you that the market is frothy, but Jay Powell said that recently too. Between 1995 and 2000, the equity risk premium was always between minus 100 basis point and zero. So it just tells you that you have to have a good risk management in place. But on the other side, it also gives you a clear hint is that as long as growth is not faltering, and I'm not really saying earnings growth, just GDP growth, and as long as you have an inflation environment between 2 and 3%, then you have nominal GDP output in the USA about 5%, and we all know that nominal GDP growth has a very strong correlation to S&P 500 top line growth. And that's actually what is, I think that's also one of the reasons why we are also still having an overweight equities over the fixed income part. If I can just have another 20 seconds for my market in Switzerland. I mean, we here in Switzerland, we have a completely different setup. The whole yield curve is below 50 basis points. So there you almost, you are even pushed a little bit more into equities, maybe into dividend yielding stocks, but we do not have the luxury to have an environment where the whole yield curve is like 400 basis points or higher.
You are definitely in a unique place. How about you, Edward?
So, I mean, I think Thomas made a good point about how to use things like equity risk premium or any valuation metric, whether it's absolute or relative. They don't tell you anything about the likelihood or the likely sign of in front of the returns of the next 12 months or the next 2 or 3 years, really, either. There is a good relationship between some of these things, particularly relative measures like the equity risk premium and much longer term returns, and they attenuate our expectations for particularly US equity returns over the next 10 years, which affects how we do our strategic asset allocation exercises. But tactically, there isn't really information in them. And yeah, you could have started this year making the exact same points you could have started making last year. Business cycle risk is priced through the floor. Credit spreads are super tight. Valuations are very full. Long-term earnings growth expectations, looking at the Bloomberg consensus numbers, very, very lofty. And all of these things are right, and they ratchet back any reasonable assumption of medium-term returns, but they don't really tell you much about what the next 12 months is going to hold.
Oh, very good.
But sorry, just very finally, but they do, again, to pick up on Thomas, another great point. They do make the market more vulnerable, I think, to a growth or interest rate related shock because there's no cushion.
And that's kind of been our point of view as well. I mean, you took quite a few things from a little Outlook presentation I have that would reiterate your points, Edward, that just the bar is really high. Earnings growth expectations at this point are quite lofty versus the last couple of years. Actually, revisions were a little negative going into the reporting period we're now going through, although there's been some good news with actual results. But the bar is even higher as we look through, progressive quarters, and with interest rates where they are, it creates very little room for disappointment, if there is disappointment to be had. I think all of you all hit on the US. There's a couple of questions in the chat about the US versus elsewhere. I'll show one more little picture that isn't going to surprise any of you all, but to use the phrase of the time, US exceptionalism is clearly standing out. You can see this as a 2-year chart. Most of this performance has happened over the course of the last 12 months, but the spread has just kind of gotten crazy. I've used Bloomberg indices as opposed to other indices, but you could think the same thing with the S&P 500 versus the stocks versus MSCI Asia versus MSCI emerging markets. You get the same picture. And it's pretty extraordinary. And clearly the vanguard of all of this is the Magnificent Seven. Going back to Trump policies, we've hinted about this a little bit, but if you look maybe beyond 12 months, you can think a little bit longer. You could think all 4 years, you could think 18 or 24 months. Do you think Trump's portfolio of policies, as we've discussed, all else being equal, do you think it extends US exceptionalism, or do you think it's a challenge to US exceptionalism? Any thoughts on that one from a market perspective?
Well, I mean, I will just reiterate the point that I made right at the top of my first answer, is that we don't know, and I don't think anyone knows, and it depends on what combination, what quantum of policies, and in what order they come. And you could construct a very reasonable, plausible argument for them extending US exceptionalism, and actually on the other side, not only not helping out other markets, but actively making their lives more difficult. Or potentially quite the opposite. I think that just on US exceptionalism, though, it's quite important to also just qualify the narrative of what exactly is or has been exceptional. Because nobody, I think, in the world calls the FTSE 100 exceptional, right? Or at least in positive terms, right?
It is exceptional.
Yeah. Nobody calls it exceptional positively. But you strip out the Magnificent Seven and compare the S&P 493 to the FTSE 100 in total return terms.
Yeah.
Over the last 3 years, they have delivered the exact same return.
Yeah, you know what? I'll go back to this little picture. The orange line, amber line in Bloomberg speak, is the US X Mag 7. And you can see it's less than world, just a smidge over Europe over the course of the last 2 years. So perfectly made point, Edward. Any other thoughts, Thomas or Johan, on the US?
I mean, based on that picture, it's very obvious where Trump will put his focus, continue driving growth, not only for the US, but for the S&P 500 in general. I think one important thing to mention here with the Trump administration is that, a lot of the nominees are not that experienced within their field, and they're also trying a lot of things that are new. And of course, that could be successful, but it could also be a disaster. So in answering the question of if it will be successful or not, I think no one here really could provide a good answer to that. But I mean, if we move over to Europe, I mean, we have still so much issues with our markets. how we handle it. It's too much red tape. There's lack of innovation, and it's also obvious that that is increasing and not decreasing compared to the US. We have had issues with trade unions negotiating way too strong wage increases across Europe. We have a challenging energy situation, no firm direction or that needs to be solved, like policy for momentum of change in Europe. And we have a complex relationship to China. I mean, those are obvious topics that we are challenging with, and I don't really see the same challenge in the US, to be quite frank.
Oh, fair enough. Thomas?
Let me make 2 points. I think whenever it comes to US exceptionalism, and you see that comparison between what the S&P 500 has done against the stock 600 and so on, I always like also to show how earnings have developed. And I mean, we have seen, European earnings, some of the earnings are still where we were like 10, 15, or even 20 years ago. But one point I also want to make is that now everybody is asking what is the impact of Trump on the S&P 500, and I always make the example of Germany. I mean, look at Germany, look at their political setup right now, and the DAX is hitting new all-time high all the time, despite we having a growth environment, I think, in Germany, which is at best stagnation. So sometimes economy is one side, and on the other side is really then what the stock market is doing. And you said it before perfectly. The US X Magnificent Seven looks quite different, and that, so now we can come back to the inauguration. That's also one of the reasons why the Bezos and the Zuckerbergs were all there, because they hope that their little empire will be protected by the new administration.
So I have two. I'm cognizant on time. There's a couple of really interesting questions in our chats. There's two things that I want to hit on, combining some of those comments. One relates to sector exposures. The other relates to China. On the sector front, one of the questions related to Mr. Musk and Mr. Trump. One is drill, baby, drill. The other is clean cars. You'd think that there's a disconnect with this. We could also throw in the world of AI and other tech luminaries, as you all have highlighted, that are on the bandwagon. With the backdrop we have, Trump being part of that backdrop, what sectors look most interesting? And I realize this is kind of getting a little bit granular, given in ways some of you all's job and what you tend to look at a strategic level. But are there the quote winners or losers that you're most intrigued with from sector exposure, whether it be US or whether it be global?
Well, I think because we're sort of sticking with our sort of prepare but don't predict. When we're looking at all the variety of risk, whether that comes from the Trump agenda or beyond, we're sticking with a very well diversified portfolio. There are returns, so no investor can try and pick the biggest winners year after year. If that's your strategy, you're probably going to fail, right? The US market has just proven that for a long time. Maybe in emerging markets, but not in the US. It's too over-researched. But there is good evidence that if you have a diversified portfolio of companies that demonstrate markers of quality, markers of persistent above sector return on invested capital, and over the long term that will come good. Obviously, that diversified approach has been challenging when 2 years in a row fewer than 30% of companies in the S&P 500 have beaten the market, but we're still sticking to that. And actually looking at last year's sector return breakdown actually should just remind you that there are good returns to be had in all sectors. Yes, tech did very well last year, but actually there were good gains in media. There were great gains in banks and utilities. Banks and utilities older, boring parts of the market, right? But you need power to power the data revolution. And banks have been overdue a bit of a run for a while, in our opinion. So yeah, because we don't believe we can predict what Trump is going to do, we're thinking diversified.
Oh, fair enough. Thomas, Johan?
Well, I mean, go ahead, Johan.
Yeah, I mean, as I said in the beginning, we still think that the economic momentum will broadening. Then, of course, you quoted the Trump on drill, baby, drill. The actual fact is that, I mean, with these massive AI investments, we will need all energy resources available. So that will be oil, that will be wind and solar power. That will basically be the whole kit of this of power generating. So I don't think necessarily that oil companies will benefit, are going to be the only one benefit from this. But I mean, one sector that we look at that we think is very interesting is still small caps in the US.
Oh, fair enough.
I mean, when we're looking at how the global economy should perform in 2025, I still think that the pair trade long discretionary against staples makes sense. I am a long-term tech bull. However, I think some part of the tech space are really a little bit frothy, and I think some part are really a crowded long. That's also one of the reasons I said internally recently is that maybe the 26th of February might be an important day. NVIDIA numbers, not only because of the stock, but we have so many others from the Mag 7 that are on that, let's call it AI bandwagon. So that is definitely something that could, I'm not saying derail this bull market, but at least give us back some volatility to also maybe buy some stock at a cheaper level.
No, fair enough. Like, there was another question before I get to China. There was another question that came in. It's not sector, but asset class. But well, actually, two questions on the same topic. That is, what about crypto? Do any of you all have a thought or perspective on crypto at this point? And if you don't, that's fine. You know, some people do, some people don't.
I mean, I'm skeptical that it's serving the function of gold in people's portfolios. Here, there's this idea that it's the new portfolio diversifier. That is just not really empirically very accurate. It has a pretty high correlation to the NASDAQ. It has a pretty high correlation to a high beta factor within US equity markets. And there is little evidence that it is functioning well as either an inflation or a risk sentiment hedge at all, which tends to be why you have gold in there. So from a portfolio construction point of view, I don't buy that argument that some investors are going to make. You know, there's a lot of speculation in the asset class that's been going up, and momentum is a powerful thing mixed with that kind of behavior.
Indeed, momentum's a great thing until it's not. So exactly. Anyway, we don't have to go crazy on the crypto, but Johan or Thomas, if either one of you have a thought, feel free, or we can shift gears.
Yeah, maybe it's more.
I have a view on crypto in particular, but it's always an interesting phenomenon when you see so high inflows in something that is so extremely speculative. It tells you a bit of where we are on the risk scale.
Yes.
Well, I mean, it's maybe more a private comment, but you know, when you see people like Larry Fink or Jamie Dimon turn from being completely against it to be more pro it, and then also with the launch of the BlackRock ETF, I mean, then the demand is huge, the supply is limited, and we all know what the price is doing then. But I think what I also don't buy is that it's a digital gold. Sorry, guys, far too much volatility for that. And it's also, I think, when I look at the sentiment, I have some colleagues, when Bitcoin halved, they wanted to sell everything. And now at 100,000, they say, well, it's an easy bet for 200,000 or 300,000. So this is really one of the maybe most sentiment-driven asset classes that we have right now. That doesn't mean that you can make money. That's not what I said. It's just with the risk that you are having in your portfolio.
No, fair enough. Okay, well, let's last topic, because again, I'm cognizant of time. I was making one of my regular visits to Hong Kong and Singapore, Tokyo, back a couple of months ago, and it was interesting. One of the phrases that I heard at that point was ABC, anything but China, and you know. I think some even go to the point of, having been hyped as much as it was as things were opening up, and now it's almost uninvestable in a way. That said, there's another sort of tug of war battle going on here. And clearly, there's a building set of policy stimulus. We'd argue there's probably more coming with the MPC in March. There's also an ongoing sort of flow through of what's been a 10-year initiative driven by industrial policy to drive innovation and consumption. And yes, we know what the negative is. The property crisis, demographics are very challenging, and getting more so. And then you layer onto that Mr. Trump and potential tariffs. What do you think of China? Is it a place to be looking for opportunistically in 2025, or are the hurdles too big? Who wants to jump in this one?
We're still strategically underweight because of that. Yeah, as you say, it's well known, but because of the fallout from property. So in the run up to everything going wrong in the property market, real estate activity in China got to 30% of China's GDP. Now, you've only ever seen that before in Japan in the late 80s and Spain around 2010. And we know that the aftermath of those two phenomenon was extremely painful, a protracted balance sheet recession. And that's in markets that can adjust relatively freely, right? In China, they are managing the adjustment with state levers, but that only it makes the pain perhaps less acute, but I don't think it makes it, I think it actually makes it more drawn out. And Beijing seems to have finally done enough to sort of put a floor under things, but we'd struggle to see a catalyst for upside with those pervasive structural headwinds. I mean, speculatively, I wouldn't be surprised, going back to the main topic of today's webinar, I wouldn't be surprised if you see Trump cut a deal with China. He speaks of national security and uses the word deal in the same sentence. Now, national security is supposed to be this inviolable thing, right? But for Trump, it's something you can make a deal over. And he's been talking about that in terms of TikTok. So, maybe that headwind for China goes away and you can see a rally, but that's pretty conjectural for us.
I mean, for me, is that if I have to invest an incremental dollar where we are right now, I want to buy visibility, and I don't have that visibility when it's coming to China. So I'm there with that. But I mean, strategically, we have an underweight there. And even if the market is turning, I mean, we have seen that last September, there was like a 20, 25, 30% rally, and it faded away. So it's something maybe for traders, but if like we also do our SAA, it remains an underweight also in the emerging market bucket.
Fair enough. Johan.
Yeah, and I will be boring and say that I agree with both Edward and Thomas. I mean, from our perspective as well, and as you were mentioning in the beginning, Tim, I mean, you could do trade speculations when it comes to stimulation of the Chinese economy, but momentum when it comes to policy, the demographics, all those structural challenges, we don't see anything in the short or midterm solving that. Then we argue for India as a better option.
No, fair enough. Well, that might be the the next conversation. I want to bring things to a close. There are a couple things that I would say up front, and one of these is an unabashed plug. If you would like details on at least our thoughts on the U.S. election, we have a big and newly updated U.S. election report, and we've got another one coming out on tariffs next week. And there are a series of other things I've alluded to in here where we've got deep dive research reports. So that's number one. Number two, I'm going to share a last screen. I mentioned the Evenco Fund Forums. If you think this webinar has been an engaging, interesting discussion, there are lots of those to be had at these fund forums in person, plus all the networking that goes along with it. So please jump out, and you'll find that up on the Evenco website. And then last, but certainly most importantly, I'd like to thank Edward, Thomas, and Johan for sharing some time and some really interesting insights today. It's been a pleasure to have a conversation with you all.